Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are higher here. The Nasdaq reversing earlier losses. The tech trade has been a dominant force, we know, in this stock market rally. It's been minting new millionaires, and joining me now on this, we've got Yahoo Finance's David Holler. David, so you have a great story out. This AI rally, you say, my friend, it is minting millionaires at the fastest pace, you say, in 4 years. Break that down for us. How much wealth creation are we talking about?
Right. So, Josh, globally, over 2025, so ending January 2026, about 2 million new millionaires were created, and in total wealth of this group, anyone with $1 million and above climbed 9% to $98 trillion. And the biggest leader for that story of wealth creation in that time was the stock market, which has been predominantly heavily weighted to the big tech players that have been investing in AI. And to put it in simple terms, the report basically says that the AI trade is a key driver of wealth creation so far. And
who do we have line of sight, like who is getting rich here? Like, is it the average Joe, your ETFs, your 401ks, or it's somebody else? Or maybe it's both?
Well, yeah, so this study I looked at, it only paid attention to people with $1 million or more, which they define as high net worth individuals across the world and especially in the US. But really, for what we're talking about here, anybody with a broker account or a 401k is benefiting from this AI rally. And this isn't something that you're not aware of, that the stock market's been going up since 2023 every year. But that's been the big thing. And the other thing here too to know is that it's the highest in 4 years. So the last time we saw this was in 2021. Back then, equity allocation for this group, high net worth individuals, was about 30%. Right now, it's gone up to 27%. So they're still this group is still actually under allocated equities.
And then of course, David, you've got massive IPOs on the way. So OpenAI, Anthropic, SpaceX. How does that sort of play into this dynamic we're talking about?
Right. Well, in one way, you can see them as a huge wealth creating events that are coming up. But in the other way too, it's a huge test for markets and really what the appetite is. Like, obviously, a big part of this group of high net worth individuals, they have access to alternative investments like pre-IPO private equity investments that regular investors don't have. And so this is going to be a shifting moment, and it could be really big. But for the insiders of the companies, like the founders, early employees of startups that are going public this year, it's huge.
One other stat I found interesting in your story is you talk about how these wealthy investors, newly minted millionaires, they are now kind of spreading their money across multiple firms. So it's not just one advisor anymore. Talk about that.
Right. This has actually been a pretty long-term trend, which is that, you have something like cryptocurrencies or alternative investments, private equity, that higher net worth individuals can get access to. But traditional wealth management players have been slower to adopt and add on to their platform for a variety of reasons. And so what you've seen over time is that clients get, or wealthy people get ideas or referrals from other people about how to get into those areas. And over time, it's kind of created this situation where there's been a huge fragmentation. But you've seen companies from Charles Schwab to BlackRock actively over the years trying to again, sort of get these other more exotic investments back to the market. But it is funny that equities for the past year has been the thing that has been driving wealth.
Switching gears, we talked about these massive IPOs on the way. You got another story out and talking about how Jamie Dimon himself is helping kind of drum up interest for this massive SpaceX IPO. What is going on there?
Yeah, so Jamie Dimon has stepped into a JP Morgan deal many times in the past to sort of smooth it over the finish line. But this is a big play by the CEO of the country's largest bank coming out. And what they're effectively doing is they're doing a global simulcast at 6 p.m. tonight from their Manhattan headquarters, and they're going to be broadcasting to about 90 different branches and private bank offices to clients to talk about the SpaceX IPO, and there will be SpaceX executives there too, as well as Diamond's 2 top lieutenants of the consumer bank and also the asset wealth management division. So really, this just kind of underscores how big of a deal this IPO is for banks. And you can look at the amount of money that JP Morgan is one of 23 banks that's going to be making money off of this IPO. But you can also look at the other IPOs coming down the pike. And this is an example of JP Morgan trying to flex its huge branch network to try and show clients potentially in the future that they can do this for them too.
And by a data point that I thought was interesting in your story, you highlight how SpaceX could allocate as much as 30% of shares to retail investors. That's roughly, versus 10% you would think of as like in a typical IPO.
Right.
Why does that matter?
Well, Musk for a while has always talked about how retail investors are a big component for his other companies, and he wants that to be involved too. And I think that it might be a stretch to say that this is a part of the democratization, but I think that it has a lot to do with believing in Musk, and a lot of retail support is there for that. I think the other side of it too has to do with the fact that if you just look at the IPOs in recent days, they've all needed more retail support. Retail has come out a lot since 2021, really, as a bigger player as a group compared to institutions in these IPOs.
All right, David, 2 great stories. Thank you, sir. Appreciate it. Let's talk more now about the macro and dive into the fundamentals for the U.S. economy as markets hit the midpoint of the year. Kevin Gordon joins us now in studio. He is, of course, head of macro research and strategy for the Schwab Center for Financial Research. Kevin, always great to see you. Let's start off there with the economy, kind of big picture. I'm just curious to get your take. I do feel like a lot of people have kind of kept waiting for like the U.S. economy to do like a face plant. Hasn't happened. What do you see?
Yeah, well, certain segments of the economy have face planted at various points over the past several years. I think that what the focus has been, in particular to if you think about the broad economy, for a broad face plant has been the labor market. And the more data we get, of course, we'll get another confirmation probably from the jobs report tomorrow. The more data we get on the labor market suggests that we have seen a lot more stabilization. You probably did see the lows of the cycle last fall. Very different than saying we're going into this employment and hiring boom. But I think at this stage of the cycle, given how disjointed things have been, the best case scenario for labor is just that continued stabilization, just given all of the supply
low hire,
side
low
pressures.
fire.
Absolutely. So the low firing aspect I think has been most important, and as we highlighted in our mid-year outlook that we put out yesterday, that's probably still going to be the main focus moving forward. So that initial jobless claims and job posting data is probably going to be, or at least have more of a weight than something like just a non-farm payroll statistic.
Is it really the AI boom that's been powering this U.S. economy at this point?
Not exclusively. I mean, it's certainly, when you look at the growth impulses quarter to quarter, that has been, of course, a powerful driver. I mean, we still have pretty high conviction that you're going to have more support and continued support from that private investment and CapEx boom. There is a little bit of an offset there because a lot of that equipment is imported. So the import bias suggests that you have a subtraction from growth, and that's from that side of things. But on the investment side of the ledger, it's still pretty strong. From a consumption standpoint, I think that is kind of the wild card for the second half of the year because so much of the inflation pressure that we've seen so far has started to weigh a lot on consumer income growth, not yet on spending, because there's still a relatively healthy cushion from a wealth effect, which we've learned, and also a drawdown in savings. But the longer you see higher energy prices, and the longer that weighs on the consumer, and if you don't see a booming job market, that probably gets you into a weaker consumer stance for the second half of the year. Not necessarily anything outright recessionary, because I think you'd have to see business investment really slow down for it to be recessionary for the overall economy. But going through some sort of growth recession maybe for the consumer, again, assuming that is the case of higher energy prices lasting into the second half of the year, it can't be ruled out.
We talk about the consumer here, we always say the consumer, but of course low, middle, high.
Sure.
What are the differences you're seeing there?
I mean, certainly, when you think about how much spending is affected and income growth is affected when you do have these bouts of inflation. You do focus more on that middle and that lower end consumer. I think the one thing that'll be interesting to look at, especially as it pertains to the beige book that came out from the Fed yesterday, there was a specific call out to the middle class and how much they're having to stretch their dollar. You don't tend to see that focused on as much. You tend to see, up until this point, it has been the focus on the very bottom of the wealth and the income spectrum. So the fact that it's just creeping up a little bit more into that bigger bulk of the economy, and certainly where a lot of the spend is, that is something worth watching. I don't think that it's going to be this moment in time. I feel that a lot of people who have a lot of angst around consumption, falling, tend to think about it as this moment in time. 1 month we're going to get this data point where it proves that the consumer is flailing. That's just not necessarily the case. So I think that it'll be sort of this process over time. If we start to see, any, I guess, fears creep up the income or the wealth spectrum, that to me is more of a function of stock market weakness because of the wealth effect for higher earners and those who are.
On inflation, reading through your notes, you did sound, broadly cautious. Is that fair?
Yeah. I think the base of inflation pressure has certainly widened, which is a little bit concerning in the sense that the base of growth for the U.S. is a bit narrower. But there's also a little bit of a sort of vicious circle going on here because a lot of the inflationary pressure that is being generated from this CapEx cycle, it is, that is in a form a demand shock where you go through, heavy business investment, but you're starting to see key components of that AI trade, whether it's, software or computer and equipment. All of those aspects and components in CPI or PCE are starting to show, some pretty considerable heat over the past few months. So assuming you don't get a slowdown there in that investment, you can probably expect some continued upward pressure there. But you sort of have these three prongs. You have that, you have, of course, the supply side shock on the energy front, but then you also have still some lingering inflation from tariffs. I think that the benefit is that the biggest impulse from that is probably behind us in terms of core goods, seeing that really big pickup in prices. But you haven't come back to what is thought of or thought of as a normal sort of growth rate for core goods inflation. We're kind of hovering around this 1%, year over year territory, which in and of itself is not terrible. But when you think about the fact that in the past couple of decades, it was normal to see goods deflation, the math is not necessarily helping you there in terms of broad CPI and bringing you closer to 2%.
What does that all mean for Kevin Warsh and the Fed?
I think it makes it really tough, certainly to entertain cuts for the rest of the year. You're hearing a lot more Fed officials come out and speak about this. Jeff Schmidt from the Kansas City Fed was just speaking in the past hour about having to entertain potentially, raising rates. I don't think that's certainly not our base case right now, but the more that chorus grows, you have to sort of get more realistic with the idea that maybe policy is not as restrictive as it needs to be for getting inflation down. Probably the ultimate obvious statement because we've been above target the Fed's been above target for almost 6 years at this point. But I think that some of those impulses, especially from the business CapEx side, those are going to make it pretty hard for them to entertain the idea of cutting.
In terms of what this all means for investors here, Kevin, you say the equity bull case is real. Break that down for us.
Real in the sense that, when you look at the earnings backdrop this year.
Impressive. Very
impressive. And I think that, certainly at odds with history in many ways. There's so many angles to this, but one of them just being the fact that when you have this kind of earnings growth, it's not typical in year 7 or 8 of a cycle in a bull market or an expansion. And then you layer on to that the fact that as we've gone throughout this year, earnings estimates have continued to move higher. Really not something that you see in any normal earnings cycle. Typically they sort of get cut and then companies beat and then you have the rate get revised upwards. So it does raise the bar for earnings, but clearly the market's been able to clear that hurdle relatively well. Of course, with the aid of a lot of the hyperscalers and the mega caps. But at the same time, that is somewhat justified by how much their earnings power has grown as a share of the market over time. So you could look at it in both good and bad ways. Good ways with what I just said, bad ways with there could be too much of earnings reliance just on a
Well, I want to ask you that comes up a lot on this desk recently. Market strength, too concentrated.
Yeah.
What do you, is that a warning sign to you?
So to me, the warning sign, when we think about market concentration, I don't think of the warning sign as the statistic of the top 10 companies in the S&P making up 40% of the index's market cap. I think of the more worrisome sign being if you get to a lower and lower share of companies that are outperforming the index or that are moving higher. That's when you tend to see more, sort of imminent correction risk. We are near that territory in terms of, on a rolling 3-month basis, only 23% of S&P 500 companies outperforming the index. But I will say that in the past few years, that's been more of a correction risk flag than an outright bear market flag, because the last 2 times we had a share that low or lower were 23 and 24. Of course, you had some, pretty significant corrections for tech and for the broader market at points, in those years, but clearly wasn't consistent with the bear market. So I think you would need to see more of a breakdown in the earnings and the fundamental story for that to turn into a more bearish market story.
I just want to end here on a big story today, Kevin, which is Broadcom. Reports, gets whacked.
Yeah.
Did you look at that and say, okay, that's a Broadcom specific story, or was it suggesting to you something broadly about chips? Although, listen, the SMH, I mean, you're only edging lower here today.
Well, I think I'm not an individual company analyst, but in any company or industry that, if they miss on any revenue guidance or if it comes up short relative to what the street was expecting, regardless of what the result is, if it's a miss in expectations and if it's a mismatch there, that's, I think, very, very much sort of an applicable way of thinking about how the market may be positioned and can get off, sort of wrong-footed in a lot of this, because that's actually what sort of took you down in early 2000 and what caused the market to ultimately roll over. It was this mismatch in expectations. It's not that earnings and revenue all of a sudden evaporated for companies and for the largest companies. It's that there was just a mismatch in expectations. Companies couldn't keep up. Not at all suggesting that we're repeating that period exactly, but I think in any cycle you have to sort of keep in mind that potential mismatch for what investors are expecting and versus what companies can actually deliver.
Kevin, always great to see you, especially on set. Thank you, man.
Thanks.
Coming up, SpaceX could become part of your 401k portfolio without you even knowing it. We'll get you the latest on that. That's next on Market Domination. Elon Musk, SpaceX is expected to go public soon, and with that, it's also expected to land in millions of Americans' 401k retirement portfolios. Yahoo Finance's Carrie Hannon joining here for a closer look. All right, Carrie, so maybe start here, Carrie. Just explain to us, how does SpaceX, Carrie, land in my 401k without me ever even buying the stock? How does this happen?
Exactly. That's the big news here, is that with this massive monster IPO with SpaceX, the rules have been eased that used to protect, that were put in place to protect investors, passive investors in these index funds from having shares of companies that are unprofitable and don't have a track record. Included in these indexes. With this new IPO, the rules have been eased to allow index providers to permit this kind of IPO to come into the index without having that profitability piece to it. And so, and in fact, they've eased the time period. So where it used to be a company maybe had to be trading for at least a year or show profitability for at least a year, now index fund providers can put this particular stock and these large cap stocks into your index fund in as little as 5 days in some cases.
So Carrie, let's say, okay, I own a standard, index fund. What kind of exposure am I looking at here to SpaceX? I mean, is it small percentage, material percentage? Frame it, Carrie.
Yeah, Josh, it's really not a huge percentage. And when we think of, say, the Russell 1000 or the S&P 500, these indexes follow the largest companies in America. That's what it's computerized. It's not people picking stocks. It's very specific, and they're aligned with that. If you have, and most of us in our retirement plans have target date index funds, and if in fact that is what you have, say that SpaceX makes up 0.15%. That stock is 1.5% of that target date index fund you own. But your index fund your target fund is balanced between 60% equities, 40% fixed income bonds. So your percentage of that SpaceX stocks is super tiny. It's like 0.9%. I mean, it's very small. So from 0.15 total in there, but when you get down to your fund, so it's really initially quite a small percentage, but it's still kind of titillating to think that it is in your index fund.
Let me ask you, some critics might say, Carrie, you know what this is doing? I'll tell you what, we're turning retirement investors, retirement portfolios into exit liquidity for insiders. Is that fair, Carrie?
It is fair. I mean, many people I've talked to who said that. And the fact is, here's what's happened. Once it is listed in the index for your index fund, these funds have to buy the stock. So there is an available market. So whenever the insiders are holding, there's a small amount of those shares publicly out there initially. But during they hit certain barriers, they'll be able to open up, the insiders begin to sell and move those out. And that's when they have a given, the market is there. They don't have to worry about who's going to buy these, because the index funds, by just the way they're set up, are required to buy the funds that are the largest companies in America. And in fact, this will be it. So yes, in fact, it offers an opportunity to say, yeah, they must buy this stock.
So bottom line, Carrie, let's bottom line. I'm a viewer right now. I'm a long-term investor. SpaceX, it's in my 401k now. Is it something I'm worried about, Carrie, or you know what? Ignore it. You're going to be fine.
I say, Josh, don't be alarmed. I think, a lot of people are going a little like, oh my gosh, this isn't right. They've relaxed the rules. This is risky for all of us who are just passively sitting by. But frankly, it really is a relatively small. Now, over time, as the capitalization grows, it'll be a bigger percentage, but it's fairly small right now. And we're all talk a lot about it's important to have diversification in our investments. Here's an example of a company that yes, has no profits today, but certainly has a lot of potential in a market area that is growth oriented. So say, don't freak out about it. Keep an eye on it. If you're really concerned, then invest in something else. But the indexes, in fact, are going to have SpaceX in that index fund that you own in your employer-provided retirement plan.
All right, don't freak out. That's just generally good life advice. Carrie, thank you. Appreciate it. Liftoff is the latest sign that the IPO market is reopening. The mobile app marketing platform debuting on the Nasdaq, pricing above expectations at $23 per share. This is coming after shelving its IPO plans earlier this year. Joining us now, we got the CEO of Liftoff. That's Jeremy Bonney. Jeremy, it's good to see you. So I was reading, Jeremy, you all actually postponed the IPO earlier this year. So maybe start there, Jeremy. I'm just curious, like what changed? Yeah. Why make the public debut now?
Yeah, it's great to be here, Josh. Thanks for having us. We had a really strong start to a roadshow in late January, and the momentum was very powerful. We were coming off of 9 consecutive quarters of growth, and then we had 2 3 Sigma days across a 4-day period, and the market looked pretty choppy. And we had the benefit of being able to make a choice. We went back home, grew another quarter, now at 10 sequential quarters, averaging 8% growth. And the investor enthusiasm had started to really build. The market has started to strengthen, and the momentum was there, and we're really excited to be public today.
And part of the reason it got choppy, Jeremy, is, all of a sudden you had these AI fears front and center when it comes to the software sector. This idea that, AI is gonna hurt software, not help it. And I'm just curious, how you think through that.
Yeah, great question. I think that there has been some discernment between who is an AI winner or AI native and who's an incumbent that needs to restructure or reapproach their business model. The business within the ad tech segment, and particularly the recommendation engine businesses, are built on artificial intelligence. The decisions to serve an ad, how to price an ad, this is foundational to the business. And I think that investors started to sift out which businesses are truly powered by AI. And in our case, this is a business that's highly profitable, growing, and leverages AI in its core, as opposed to ancillary utilization. And so I think that's something that became very clear to investors.
I was reading, Jeremy, you actually developed your own AI engine called Cortex. Can you explain just what that is and what that does in simple terms?
Yeah, exactly. So we moved from the previous paradigm of decision-making of which ad to show and how to price that ad was based on what we call linear regression. The easiest way to understand that shift is that by moving to neural nets, your model or your brain size gets 20 times bigger. We can hold 20 times the information in our brain today, and the model gets smarter much faster. So the models that Meta's recommendation engine is built on, for instance, these are neural net backed or AI backed, bigger brain, faster decisioning, easier to extend upon, more extensible. And so for a recommendation engine that's identifying ads like our business, it's extraordinarily powerful. I mean, it's truly built for purpose.
Jeremy, I see you sometimes compared to AppLovin, and I'm just curious how you think about that, how you think you compare and contrast, what your competitive advantage is.
Yeah, Liftoff operates alongside App in this mobile app economy that is giant. Now, we're different in a few ways. We were built day one to approach the entire app economy, from fitness to finance to social to prediction markets like the Knicks game last night, or the World Cup, to sports books, to gaming as well. We've been built for this entire expansion into the app ecosystem, and that approach is differentiated from the remainder of the players across the ecosystem. But I think it's really important to appreciate the space that we're operating in. The mobile app economy has the least density of advertising dollars per user hour of any screen, 7 cents per user hour. So this is 1/6 the density of TV. So we need multiple models like AppLovin's Axon, Liftoff's Cortex, and a variety of others to build the density in this market that it deserves. The mobile phone is where we spend our time, 3.5 hours a day, and there's so much room to grow. We have to take a few different approaches from some great businesses in order to get there.
Jeremy, I want to dig a bit more into your financials. It looks like revenue grew about 32%, Jeremy, I think, year over year in 2025. What's driving that acceleration, Jeremy? Where is that growth coming from?
So we released Cortex in Q4 of 2023. And since that launch, we have grown the 10 consecutive quarter span through Q1 at an average of 8% per quarter. What's happening during that time is our model is consistently getting smarter. We are certainly helping the ecosystem grow and benefiting from the secular tailwinds of time spent and advertiser density. But this model is absolutely a primary component of the growth of this business.
It looks like strong operating income, Jeremy, but still a net loss. Just walk us through that and the path you see ahead.
Yeah, this is a profitable business and has been profitable for some time. As with the IPO, we pay down some of our primary to get to public company leverage. And so you'll start to see the cash flow modify from there.
I think, last question, Jeremy, a lot of times investors, they'll hear AI company and they'll think, okay, so long term, this is going to be, meaty, impressive software-like margins. Is that the right way to think about it?
Yeah, Josh, there's a lot of leverage in this business. We have 650 people at this company. When you release a model improvement, you can go and acquire more users for your advertisers that allow you to scale the business without going and adding new customers or new cost. And so the leverage in a business like ours that's built on a recommendation engine is tremendous. You see that from Q1 of 26 over Q1 of 25, there's a margin expansion of 600 bips. And that's the kind of leverage that can be achieved as the business scales.
Jeremy, great to have you on the show today. Congrats on the big day.
Thanks so much, Josh. I really appreciate it.
Coming up, how Microsoft is looking to advance its artificial intelligence plans without OpenAI. That's next on Market Domination. The AI race between OpenAI and Anthropic is heating up, with both companies eyeing to go public. The IPO race is just the latest snapshot of the two companies eager to one-up each other and dominate the AI market. Let's look into the outlook for OpenAI and Anthropic. Hayden Field joins me. She is senior AI reporter at The Verge. Hayden, it is great to see you. So let's dig into all things AI, Hayden. Maybe we can start with Anthropic, confidentially filed. When those official financials hit, Hayden, on that company, which financial metrics do you think investors will make like a beeline for? Is it going to be the revenue growth, the burn rate? What are you going to focus on, Hayden?
Yeah, that's a great question, Josh. I think what I'm going to focus on is of course, the money, the revenue. That's one of the biggest things that people are talking about right now with the AI money squeeze. A lot of these costs are being passed on to customers right now, especially with Anthropic. That's been a big complaint lately from some of the big companies and small startups that are their customers. They're saying, look, the prices are too high. We're burning through our whole budget in half the year. We've got to make a change. So I think that's what I'm going to be looking at, as well as the potential risk factors that they have to list in that form. They have to say what the biggest possible risks to their business are and lay that out for investors. And I think that's going to be a really telling section.
What do you think, Hayden? I mean, you think about this company, like what would be the big risks that would be on your radar? I mean, would it be, regulation, Hayden, or competition or infrastructure costs? What do you think?
I think all of them. But, I think a big risk factor that they're going to lay out is the competition specifically. So, you may have noticed that OpenAI and Anthropic, typically they'll release similar models, similar announcements, similar, forays into other industries on the same exact day, sometimes within hours of each other. So they're really, each of them is kind of playing on a ladder where they're each one rung up and then the other one will come up. And there's no one really in the lead for a while, except in certain sectors. So I think Anthropic's going to keep going into the sectors that it is known for when it comes to enterprise, legal, certain traditional industries that were slower to adopt AI, but now really trust Anthropic. That's where they're going to find their sweet spot. Some of the other risk factors they may outline are more doom and gloom things, longer term things like, how AI might affect the economy, things like that. So that's what I'm going to be looking at. Anthropic already puts out a lot of research in those areas when it comes to AI's effect on the world, the economy, society. And so I think they may end up listing some of those things out in those bullet points as well.
Anthropic for a while, Hayden, I mean, it was sort of talked about like OpenAI's rival. It was sort of like, they took the silver, you know what I mean? But now it feels like the story has changed, and it feels like Anthropic is often talked about as in the pole position. And I'm just wondering why you think that is, Hayden. Like, what changed there?
I think that it's because Anthropic had a pretty narrow focus very early on. They wanted to focus on enterprise and coding. They never really shifted. They didn't go off on side quests for the most part. They really stayed focused on those two main goals. And now companies like OpenAI, who kind of, tried a little bit of everything, threw a lot of spaghetti at the wall, are now realizing those two areas that Anthropic originally focused on are the biggest revenue drivers. So now that, both companies are planning to IPO this year, OpenAI has said, hey, we're going to pivot and focus on these two things specifically because we really need to make money. And they even said in an internal memo that, side quests are over. They're focusing on the money makers.
The reported valuation, Hayden, for Anthropic it's incredible. I mean, we're talking about nearly $1 trillion. Why all that optimism, Hayden? Like, what do you think are the sort of assumptions baked into that?
I think there's definitely a lot of hype. We all have to remember that these companies are not making a lot of profit right now, if any. So, Anthropic's doing better than many, but $1 trillion valuation is pretty eye-popping. And I think that, that's something to remember. We'll have to see how it goes. Elon Musk's SpaceX is another one I'll be watching. It's currently set to raise, I think, upwards of $75 billion at a roughly $1.75 trillion valuation. So, that's going to be a really big number too. And, there's a lot of AI hype out there. I do think the market will correct a bit. It's going to be interesting to see kind of the consolidation in the AI market, and also what happens when these companies do have to pay the piper and kind of, show up for their investors now that they've been borrowing money or, taken their money for a long time. Now it's time to turn a profit. It's going to be very interesting over the next year to watch this.
Hey, another good story you wrote, The headline here, I like Microsoft and OpenAI broke up. And you kind of talk about how this relationship, you say it devolved from marriage to situationship. What does that mean, Hayden? What exactly changed here?
Yeah, that's a great question. You know, Microsoft and OpenAI's relationship has been a very interesting one over the years. There's been a lot of drama, a lot of changes. They started out in a pretty exclusive partnership. And then, you know, as they renegotiated their contract over the years, it kept getting less and less exclusive. Now, this past fall was the time that they pretty much said, hey, we don't have any real ties to each other anymore. Let's just, you know, basically be in a situationship, aka, you know, we'll coexist, but there's no ties here. And that is what Microsoft's AI chief, Mustafa, told The Verge that was the real turning point for Microsoft in terms of being able to really directly compete in the AI market. It can now, you know, do anything it wants, go full steam ahead without worrying about what relationships it already had. And then, you know, this past April is when Microsoft and OpenAI officially broke up. They said, you know what? They released a very short statement on both their websites, and it was just very telling. They just said basically, you know, it's over. We're still, you know, we still have to work together. Sometimes keep the lines of communication open, but they no longer have any type of, you know, really intense contractual relationship anymore.
Who has, in your opinion, Hayden, who do you think has the greater leverage here ultimately?
I think it's tough to say because OpenAI is very ahead when it comes to Microsoft. You know, they released their first reasoning model in 2024. Microsoft released its first reasoning model this week as part of Microsoft Build. But I will say that, you know, when it comes to AI, whoever has the most resources when it comes to computing and the most money is really, you know, well positioned to be a winner. And so I think Microsoft has a huge advantage there. They have a lot of compute, a lot of money, a lot of diversified revenue, and not as many investors kind of, you know, breathing down their neck saying, hey, where's the profit? So I think that's going to be really interesting to watch.
How much do you think, Hayden, developers care about any of this? Or no, they're focused on price, on reliability?
Yeah, I think developers are focused on the end game. They want, you know, the cheapest model for their purposes that will do the best job. And, you know, they're known to switch between models on the day, the week, the hour. You know, they really are just looking at what's best for their own purposes at any given moment. And actually, startups and small companies are doing the same thing. They're starting to build, you know, internal metrics and trackers that kind of show which models they need to use for the most complex stuff and which ones they can kind of cheap out and do a little bit of a simpler model and spend less money and have the same result. A lot of the companies I've been talking to in the legal space and in other sectors are doing things like that just to save a buck or two. Actually, a lot of money.
Hayden, so great to have you on the show today. Thanks for your time.
Thanks so much, Josh.
Coming up, we're calling for tech support with Yahoo Finance tech editor Dan Howley. That's next on Market Domination. Microsoft has taken another step toward controlling its AI destiny, unveiling a suite of in-house AI models. For more, we're calling in for tech support with Yahoo Finance's Dan Howley. All right, Dan. So break down what Microsoft unveiled here. Who are they competing with?
Yeah, they announced a bunch of new models, including their MAI-1 thinking. It's basically their...
Sounds like a James Bond villain.
It
Go
does.
ahead. Go ahead.
Yeah, it's basically their biggest, most important model that they've released on their own. They talk about how it's not distilled from anything else. It's developed using clean data. Basically saying, hey, OpenAI didn't help us with this. That's the whole goal of this. And really, it's about separating themselves from OpenAI and from the broader industry and saying, hey guys, we're here. We're ready to play in this
Altman
space.
who?
Yeah, exactly.
Right,
Yes,
yeah.
Who's the Sam Altman guy, right? And it is a big deal for Microsoft in that it shows that they are serious about being a player in the space. Now, they're not exactly, at the frontier, right? They're not as, advanced as GPT 5.5 or Anthropic's Claude Opus 4.8. Anything along those lines, or Gemini 3. But it is up there in their own research. They say that it matches up nicely with Sonnet 4.6. That's, obviously not 4.8, 4.7, 4.6. And they say it also has coding capabilities similar to Opus 4.6. So, that says something just because Anthropic has really made its bread and butter on coding, that AI coding aspect of it. That's how they kind of got into the enterprise big time and really blew up. And so the fact that they're benchmarking it against that says something. And I think that, obviously it's not 7, it's not 8, it's 6. It is still a way for Microsoft to kind of get in there.
What is the benefit of having your own models like this? Is it like the cost? Is it the competition? What is it?
It's not having to rely on another company. So one of the things that they're doing is, since they have had this, kind of split with OpenAI, split not split, right? They're I would consider them frenemies at this point because they're releasing stuff and then OpenAI is like, well, we got this over here. OpenAI went into the productivity business a while back, and you're like, ooh, what does that mean with Microsoft? They've had all these different changes to their agreements over the years, but it really comes down to them wanting to be platform agnostic, so they're offering OpenAI's capabilities as well as Anthropic's capabilities, but also saying, look, we have our own as well. We're developing this under Microsoft's own AI division, and so that I think just shows that they're proving their own worth, and then eventually they may be able to offer their own models as well, similar to what you see from OpenAI or Anthropic. They're not, like I said, they're not there yet, but they are seemingly on a good path forward.
Sticking with AI models, the Journal has a story, get your take on this, how Meta keeps delaying the release of its new AI model to developers. What is this model, and why are they having trouble, it sounds like, getting it out the door?
Yeah, this is their Spark model, right? And so this came out, it was the announcement was kind of, I mean, it's a huge deal. Not kind of, it was a huge deal. This is after Alexander Wang joined. This is after the issue that they had with their big AI model, Llama 4 Behemoth. It was delayed, and then just they decided to just kill it. And so Spark was supposed to be, hey, we're back. We're in there. It's not our biggest model. It's not like the best that we have to offer right now. We're working on that. But here's what we have in the meantime. Unfortunately, according to this report, they don't have an API available to developers at that point. And so basically you can think of an API as a way to plug one piece of software into another. They would offer this to developers so that they can start plugging Spark into their own applications if they want, taking advantage of it. It's not there yet. And so when you see that, Meta went out and spent all this money.
Well, that's what I was going to ask you. If I'm
talent.
a Meta investor, I'm listening to this. Is this a yellow flag? Like, am I worried about execution?
I would say it's maybe it's not like a yellow flag. It's not a red flag.
Is it yellowish?
Yeah, we would say what's in between. I mean, it's not a blue flag. That's green and yellow, but it's like off green.
Slightly
we'll say.
yellow, less than yellow.
Yes, yeah.
Okay.
It's a little concerning in the fact that they had those big delays with Behemoth that just ended up not happening, and now we're seeing more delays on their part. When you think, okay, they're dumping billions into their AI capabilities, they hired all of these smart people to go ahead and develop this. The fact that they haven't released this yet, it almost begs the question, what's the issue there at Meta? And we don't really know. They seem to be high up on what they're going to be capable of and are capable of. But reports of delays like this, it gives you pause for a second.
Final topic. Another exclusive from the Journal. Good reporters over there, by the way.
Folks.
Yeah, apparently. Basically, listen, we talk about concerns about AI, jobs, misinformation. Well, here's another word. Some top AI CEOs warning Congress about biological weapons. What are they worried about?
Yeah, this has been like the big, I think, the biggest boogeyman probably in AI, aside from it's going to take over and destroy us. Also scary, but not going to happen. There's the jobs aspect, which some people say is just overblown and isn't overblown, and there's different takes there. But this has been something that I think has been kind of across the board of fears that it could be used to develop bioweapons. And so now what they're trying to do is make sure that anybody that tries to get any type of cellular material will have to register it. And so you would be, I guess, known to the government who's getting these kinds of capabilities. And so it's not necessarily that you would go out and buy this and the government would say, okay, this person's trying to make a bioweapon. It's just they want to have an understanding of what could the AI be potentially used for. If you mix these AI models with these capabilities and you are able to make some kind of bioweapon, you want to avoid that.
Yes.
So let's know who has these, this type of material.
Do you think you're hearing about this now because the models have become that much more capable?
No, I mean, it genuinely is something that they've talked about for quite some time. And by they, I mean the industry. This has been discussed for some time. When it comes to the safety.
Was it
AI.
notable to you that Sam Altman and Dario Mode are on the same page? I mean, rivals in just about everything, right?
Yeah, won't hold hands.
Correct.
Did not hold hands in India.
But here, some common ground. Is that notable to you?
I think it's notable in that it's nobody wants biological weapons on the loose. That sounds like something out of a bad 80s action movie or awesome 80s action movie, depending on which one it is. But yeah, I think it's just common ground in that, hey, that's terrible. We don't want that to occur. So let's make sure that we can prevent it as best we can. And so you have, and it's not just Altman or Amadei, it's Mustafa
Heavy
Suleyman.
hitters, yeah, for sure.
It's folks from across the industry who are all kind of saying, yeah, this is important. Let's put our swords away for a second, or guns or whatever. I don't know, brass knuckles, and let's just be real about this. This is going to be or could be a potential issue. Let's just cut it off at the pass while we can.
Now I have an image of like Sam and Dario with brass knuckles, which is weird and awkward.
Yeah.
Doesn't make sense. But I get what you're saying. Dan, thank you. Appreciate it. Big news, Yahoo Scout is now live on Yahoo Finance. Now you can ask your market and stock questions directly within news articles and stock pages and get trusted answers grounded in Yahoo Finance, news and data. Scan the QR code to try it. Coming up, we have you covered for the closing bell on Wall Street. Don't go anywhere. stocks ending the day mixed. Yahoo Finance's Jared Blickery joins here with the key takeaways. Jared.
Thank you, Josh. Best day for the Dow in a couple months, 875 points. 1.75%, moving in the right direction. That would be up. And here you can see close pretty close to the highs of the day. Spent most of the day just camping out after that nice big pop after the open there. Now the Nasdaq Composite, well, we had some problems with chip stocks today. That's a Broadcom story, and we're going to get to that in a second. But you can see the Nasdaq finished just slightly in the red after punching into the green a couple hours ago. S&P 500 up 0.4%, so we'll say splitting the difference. And let's check out the Russell 2000. Small cap index, very close to a record high. That might be an all-time high on a closing basis, so I'll check that, but it's up 1.6%. We got to take a look at the bond market because yields had been marching higher, but today they're down a little bit. 30-year down 1 basis point to 4.98%. 10-year also down 1 basis point to 4.48%, and the US dollar index just barely trading to the downside today. Sector action was really interesting. Healthcare, XLV, haven't seen that lead in a while. It's up 3% today. That is the best in over a year for that sector. Financials also, I believe that's the best return, 2.63% in about a couple months. Real estate over 2%, and then industrials over 1%. To the downside, you're seeing that negative reaction in tech. That's a chip story. We'll get to that. And then staples and materials also slightly in the red. Now here's the Nasdaq 100. Alphabet up 3.68%. Looks like Microsoft just barely in the green. Amazon up 1.5%. But check this out. Broadcom, that is down 12.5%. That's about $300 billion or so. I think that's going to be one of the fourth, it should be the fourth largest drop in terms of market cap for a U.S. listed company in history. You can also see some other dark red here, but let me just skip over to the semiconductor board so you can see what's going on. NVIDIA and Taiwan Semi, the two biggest there. Those are in the green today, along with some others, but Micron down 7, AMD down 3, ARM down 4.5. So you can see some of the damage done there today. I did write an article for Yahoo Finance. It's on the site about Broadcom. These dips tend to get bought, but the week after one of these big dips can be a little dicey. So you don't have to rush back in, but think about that long term. Oracle up 2% in software, Cisco up over 2%. Got some other outperformers. It looks like Shopify up almost 3%. Kind of a mixed board here, a little bit more green than red. So software pulling its weight today. But if I go to our leaders, you can see we got some people at the top, similar to our sector action that I haven't seen in a while. KRE, that's regional banks, that's up 3%. And then ITA, that is an aerospace and defense ETF, that's up 3%. That was huge last year, especially after that post-Liberation Day rebound. Then we got more biotech, looks like microcaps, ARC, biotech, gambling, and the list goes on. To the downside, EWY is a Korean ETF. It tracks chip stocks. That is the worst performer here. That's down 4%. Bitcoin also had a nasty day. And guess what? I'm going to end there. You can see Bitcoin down 2.36% to 63,377. Year to date, that is just tying. That, I think on an intraday basis, we are either at or just under those lows in early February, Josh.
And Jared, my friend, ahead of that Jobs Day Friday, I know you're tracking some of the latest layoff announcements. We've seen the tech sector. What's the details there?
You bet. I got a few charts here too. So AI is coming for more and more jobs. Here's the latest. Challenger just announced that employers cited AI as a reason behind 38,000 job cut announcements in May alone. It's the highest monthly total for AI since the firm started tracking it in 2023, which we can see in this chart here. And through May, companies have already blamed nearly 88,000 cuts. That's right here, more than all of last year. So the point is not that AI is suddenly breaking the entire job market, it's that AI is becoming a big reason that companies are reaching for when they restructure. And technology is still the center of that pressure, as we can see in this next chart. This tracks job cuts in tech going all the way back to 2022. And here we can see in May, tech employers announced more than 38,000 cuts. That is the sector's highest monthly total since August of 2024, right here. And that's why this is starting to matter for investors. AI has been a growth story, it's been a margin story, it's been a CapEx story. Now it is also becoming a labor market story. But the official data is still mixed. This week we also got the JOLTS labor market numbers for April, which included some positive surprises. In this chart right here, professional and business services, job openings bounced in April, even as hires and layoffs, they both fell. So you can see that big tick up in job openings here on the right side of the chart. Should also note that we're talking about April because this report comes from the BLS the month after the main data is dropped. Translation, companies may still want workers, but they are moving more slowly, hiring more selectively, and they are pressuring all those white-collar roles that can be automated or consolidated. So the next tell is Friday, and it's going to be simple. Does this stay contained in tech layoff announcements, or do tech layoffs start showing up in the broader payroll data?
All right, thank you, Jared. Turning to earnings, Lululemon just out now with its first quarter results. We have Yahoo Finance's Brooke DeBama joining for a closer look at those numbers. Brooke.
When you take a look at what exactly the company has reported, it seems like it definitely missed the mark when it comes to Wall Street's metrics that they had in mind. The stock now falling down more than 6.5%. So let's walk you through where exactly those numbers miss. We did have full year, so the outlook, they did trim that. It's now coming in between 11 billion to 11.15 billion. The Wall Street was looking for a range of 11.35 billion to 11.5 billion. That's what they previously expected as well. Also, you did have comp sales come in less than what Wall Street already expected. They had low expectations and they came in even lower. Comparable sales for the first quarter were down about 2%, and the street was looking for about down 0.2%. Now, when it came to quarterly EPS, the company came in line at $1.69. Also, you had revenue just beat ever so slightly at $2.47 billion. That was just above the $2.44 billion that Wall Street was looking for. And so clearly, this is a company that definitely is trying to improve. We know a new CEO is coming in September. We know that they just kind of closed that page between them and founder Chip Wilson. And you also have 2 new board members coming on. But clearly, Wall Street looking for more here.
The stock was already a mess heading into this point.
Down 40%.
It was down 40% this year. It was down 60% over the past 12 months. And now trimming the outlook, so just that much more pressure on a new CEO.
Absolutely. That much more pressure on a new CEO who, by the way, from what I understand, was previously retired, a former Nike executive, I think she was. And now she's coming back to lead the helm, lead the turnaround, kind of, I guess you could say, of this company that has been under significant pressure in recent years because of the entrants like Rory and Alo and so many other athleisure wear companies. And it just seems like the company hasn't been able to keep up. Now the fact that they're cutting their 2027 guidance, even as much as their earnings per share guidance as well, is definitely not what Wall Street wants to hear right now.
All right, Brooke, thank you. Appreciate it. For more on Lululemon, let's bring in Morningstar senior equity analyst David Swartz. All right, David, so Lululemon's out. Investors initially here disappointed. What do you make of the print?
Yeah, I think people are maybe overreacting a bit right now. People are looking for reasons to be very negative. We saw that this morning with PVH, for example, which was down over 20% today. And so, I think that there's a lot of concern that consumer spending is declining and that Lululemon specifically has lost its way. As you mentioned, it is in a transition period right now with a new CEO coming in September. Unfortunately, she can't start right away because she has a non-compete agreement with Nike where she used to work. Her name is Heidi O'Neill. She used to be a product person at Nike, so she has a lot of experience in this industry. And so there are reasons for optimism. Right now, Lululemon is in a transition period, and that's true, and it does appear to be affecting the sales.
Yeah, I mean, listen, they lowered their annual forecast, so they're now seeing revenue for the full fiscal year. They're calling for a range between 11 and 11.15 billion. That's lower than the previous guidance. It's below, it looks like, the average of estimates, at least compiled by Bloomberg. I guess for the new CEO, David, first of all, two questions. One, do you like that pick, David? Do you think she has the right background experience to run the company? Two, what should her priorities be?
Yeah, I think she does have the right experience. She was involved heavily in Nike's move into women's sportswear, and that's something that is in Lululemon's wheelhouse. She is a product person. She was at Nike for well over 20 years. She was, in fact, considered to be a candidate for the Nike CEO job at one time. I think she was chosen by Lululemon's board because of her product experience in this industry over some other candidates that are out there. One that was mentioned was Jane Nielsen, used to be the CFO at Ralph Lauren. I think that from the perspective of Lululemon's board, Heidi O'Neill was the better candidate because she's a product person, not a finance person. And Lululemon's issues are really more product related than finance related. This is a company that has very strong financials with like $1.8 billion in cash and no debt. So the company is in no danger of any sort of financial distress or anything like that. It's really just a matter of getting back on track. And so you asked what does she need to focus on? And the focus needs to be on getting quality products that make people want to shop at Lululemon again. I think that Lululemon still has a very strong brand and a very strong following, but we've seen in the last couple of years that when their core customers, which are mainly women, have gone into their stores, they found, I think, too much of the same stuff that they've seen before. And so they may not have shopped like they used to and gone on to some other stores like the ones you mentioned, Alo Yoga and Vuari and some others that are also producing high quality women's athleisure apparel. So I think that Lululemon just needs to come up with some new products. There was a lot of hopes that this year might be better, but there has been a lot of distractions with the CEO leaving at the end of January. They've had a proxy fight with the founder, Chip Wilson. And so it's really been a difficult period, and it has been for the last couple of years. But Lululemon, I think, still has a very strong brand and has a lot of growth opportunities. Another important focus will be for the CEO is on the international business, which is really generating most of the growth at the moment, especially in China. There is a big opportunity there. There's also a big opportunity in Europe, where Lululemon still has a relatively small number of stores.
You mentioned Lululemon, they did end their boardroom battle with the founder, Chip Wilson, David. They agreed to give him 2 board picks. What did you make of that outcome?
Yeah, I think it was a favorable outcome. The distraction was not helping anybody. There was a lot of negative press. I don't think that was helping Lululemon at all. It does reduce some of the uncertainty because nobody knew exactly how the proxy fight would end, or even if it would end, because Chip Wilson has really been critical of Lululemon for many years, and there was no guarantee that he would maybe step away from his criticism. But now he will, because of this agreement, and it seems like he got most of what he wanted. He got 2 new board members. Mark Maurer, who's one of them, has a very strong background. He's a former CEO at On. There's a bit of an issue there in that he's a bit conflicted since he's still an On shareholder and Lululemon is a competitor. But Chip Wilson is also conflicted because he also has investments in this industry. I think that Lululemon is finding stability with the new CEO and the board in place, and that's going to be important as the company tries to turn around its business, especially in North America, which has been affected by competition.
David, I'm also just curious to get your broader take on just the athleisure sector, the athleisure space. Like how healthy, how resilient does it look to you, David? And what do you see ahead if prices at the pump stay elevated?
It has been a difficult period. There's a lot of companies in the industry that are struggling. Nike has certainly struggled over the last couple of years. Puma, for example, had a terrible year last year. So the sportswear market is not 100% healthy, but it's also a very favorable market, which is partly why so many companies want to get into it, because it is an area that still has growth. The growth of global sports drives apparel sales. It drives this industry forward and attracts new consumers to sportswear and athleisure. And I don't think those trends are going to change. And I think Lululemon is still in position to benefit from them. I do think the stock is undervalued. Prior to today's report, my fair value estimate was $295 per share, which is obviously well over double the current stock price. The company has, as I mentioned, a lot of cash and very strong financials, strong cash flow. And so, I think that Lululemon can weather the storm in that there is a favorable market and there is a lot of growth opportunities for sportswear and athleisure globally.
You mentioned Nike. David, let's just end there because their report is coming up June 30th. That stock, it's down about 30% this year. What do you expect to hear from Nike?
Yeah, Nike has really struggled. Its sales growth has gone to zero, essentially, and this is a company that historically always generated sales growth. Its expenses have been out of line with its sales, and so its margins have really taken a hit. It especially has been struggling in China. A big issue for Nike is certainly when can it turn the business around in China. Lululemon, by the way, is doing much better there, but Nike is struggling and its franchisees in China are struggling. And so we need to get more clarity on when that business may stabilize and also when growth may may increase in Europe and North America. The gas price issue and tariffs and the other issues certainly do affect Nike as a global business and can affect consumer spending.
David, as always, appreciate that instant analysis. Thank you.
Thanks.
Coming up, how you may be able to use Bitcoin as collateral to buy a home. That's next on Market Domination Overtime. AI mortgage company Better is joining forces with Coinbase to fund the first ever Fannie Mae insured mortgage backed by Bitcoin as collateral. The new endeavor allows qualified buyers to pledge their crypto holdings for a down payment without liquidating a single coin, avoiding capital gains taxes, and without giving up potential future upside from their digital assets. Yahoo Finance executive editor Brian Sozzi spoke to Better's founder and CEO on opening bid this morning.
Why does the industry need this? We've got a housing crunch created 41% of our customers have the money to pay the monthly payment on their mortgage. I mean, they're renting right now. They're already paying someone else's, their landlord's mortgage. And they've got the credit scores, but they don't have the down payment to fund the mortgage. And the industry uses a very narrow definition of what qualifies for a down payment up to now. 5 trillion of checking and savings accounts, but consumers have 35 trillion invested in stocks, bonds, and digital assets. And this innovation unlocks all of that as being eligible for a down payment.
Does the couple, whoever they may be, do they have to put cash down?
They showed up to the closing table and they didn't write a check or send a wire. All they did was pledge their Bitcoin in their Coinbase account to the Better wallet in Coinbase custody, and that was it.
How do you make money, and how does Coinbase make money?
We make money because we make the interest rate on the mortgage, and we make the gain on sale when we securitize that mortgage with Fannie Mae. The benefit for Coinbase is they make money on Coinbase custody, and they provide value to the consumer. Coinbase has been an amazing partner. What's more interesting is if you're a Coinbase One member, for this couple, they bought a $500,000 house in Ann Arbor, Michigan. They got $5,000 towards closing credits from Better on the mortgage, so they showed up to closing table with nothing, no checks to write.
What would you say to those that would say that this fuels some of the activity we saw in 2000, 2008? People are going to take out too much home because they have digital assets in an account somewhere, and they can't really afford the home to begin with.
That's not actually true anymore, because what happened after the financial crisis is there was a rule put in called the ability to repay rule. And that, for the first time, put in debt-to-income ratios as part of the monthly payment and for the calculation of a mortgage. So this couple, they've got great credit. They had plenty of savings. They didn't want to liquidate that savings, pay capital gains, and then lose that upside to buy a home. And now they didn't have to do that. And so they're in this house for $2,400 a month for a $500,000 house. Amazing.
What happens to that payment? Bitcoin has fallen through a trapdoor. I mean, it's having a horrible few months. What happens to that payment if their holdings go down in value?
Nothing.
Nothing.
It's nothing. No margin calls, no market value triggers. This is a 30-year mortgage. As long as you pay that mortgage on time, you get to keep your crypto, you get to keep your digital assets, and you get to keep the house.
What's the risk to Better if that does happen, if the value of their digital holdings goes down?
It's the same risk as one would have if they'd put cash on, right? Really, we're lending against the house with the skin in the game of the down payment evidenced through a pledge of Bitcoin rather than through a pledge of cash. Sure. And so the way we think about it is, yes, there's slightly more risk in that collateral, but that risk is compensated by the fact that we can get a slightly higher interest rate and the fact that the consumer is such high quality credit.
With crypto under pressure, what do the signups look like so far?
It's been amazing. We've got over 250 million of demand just on the wait list. Those are consumers now looking to buy houses and running around shopping for houses, bidding in the market today. And as we open this up over the summer, we think the demand's going to be massive.
Why? I was listening to your latest earnings call, and you say, the housing market's it's challenged. It's a challenging period right now in the housing market. What has to change outside of this? How do we get more homes built in this country?
I think the way we get homes built in this country, it's really weird because people don't want to build homes. Home builders don't want to build houses.
Which is crazy. They're home builders.
Yeah, they're home builders. They don't want to build houses that cost less than $400,000 because it costs $12,000 to make a mortgage. At Better.com, it costs us less than $3,000 to make a mortgage. And so that $9,000 on a $300,000 mortgage is like 50 basis points in savings. That's 2 rate cuts without the Fed doing anything. And when you think about that, that opens the way to building houses for $150,000, $200,000. Now someone who wants to buy a $150,000 house, they pledge, they've got 10K of digital assets. They can actually get into that home with 10K pledge of digital assets, $150,000 house. So we think that means home builders finally start to build houses for that. There are over 200,000 permitted lots, empty lots available for sale on Zillow right now. People just don't have the means of building a house on them.
Not everyone has access to cryptocurrencies. Yeah. What ultimately has to change, let's say at the government level, to get more human beings into homes? We still have rates that are high. I was just sitting here talking about a potential rate hike, which would be awful to the U.S. housing market.
I think the biggest thing that we need to do is bring down the cost of making a mortgage. We bring down the cost of making a mortgage from $12,000 for an average mortgage, $15,000 for bank, and we take that down to $3,000. Now we lower the rate for the consumer, and we spur housing activity. And most importantly, we spur housing activity not for like McMansions, not $800,000 houses, which is what these home builders today are building, but for $100,000, $200,000, $300,000 houses, which are a step up from renting, which is what is supposed to be the American dream, is to own your own home, get into a starter home, get into your starter home when you're 32, not when you're 42, and then trade up from there.
You know what's wild, though, Michelle, too, is that people are just not selling their homes. It's also not, the burden is not just on the home builders. The people that have been in their homes for 15, 20 years, sitting on a lot of value. They're not going anywhere.
No, and they refinance at 3 to 4%.
Sure.
And so now they've got this lock-in effect, which is why we need to build new houses. And we need to build $200,000 houses, $250,000 houses, $150,000 houses. And the best way we're going to do that is unlock down payment savings by going from $5 trillion in checking to $35 trillion across stocks, bonds, and digital assets on the down payment side, and on the other side, cut down rates by taking all of the costs out of making a mortgage, all the people, all the processes, all the PDFs, and having AI do it.
If rates were to stay at current levels, what would it mean to a company like Better going into year end?
We are innovating. We are innovating and we're applying AI, and we're saving consumers over $20,000 in interest payments on their mortgage, and so we are growing. We are growing. We've doubled our growth from last year to this year, despite a really terrible mortgage market. And the way we're growing is we're not only providing access through better.com, but we're partnering up with companies like Coinbase, with OpenAI, with Intuit Credit Karma, and helping their customers access home ownership in a cheaper, faster, easier way.
Well, always good to see some innovation. Vishal, good to see you. Thanks for coming out. I appreciate it.
Coming up, how AI is making human skills more valuable than ever. That's next on Asking for a Trend. Hello and welcome to Asking for a Trend. Well, AI may be making it easier than ever to build a company, but according to one venture capitalist, it's also making human skills more valuable than ever. Sam Lessin, founding partner at Slow Ventures and a former Facebook executive, is making headlines for hosting etiquette classes for tech founders, and he's joining us now. Sam, it is great to see you. So let's dig right into this great journal story. Talks about how your firm, Sam, they say it's now hosting an etiquette class for tech founders. So what are you teaching these founders exactly, Sam, and why?
Yeah, so the why is simple, which is, one, it's funny. And it turns out that doing funny things, there's always something. The reason things are funny is because it's surprising, but there's a grain of truth to it. Obviously, teaching about tech founders etiquette is just hilarious. But then the grain of truth, which is the important part, is we're at this moment where software is hyper commoditizing. Everyone understands this. Everyone understands you can build anything with AI. And the irony of that is that as software itself commoditizes, actually the ability to build trust with customers and relationships, in these moments where there's serious disruption, companies are looking around and saying, who can I trust to work with when the whole world is changing? It turns out that building relationships and trust and human connectivity really matters. And we can joke about etiquette, but there's some real deep truth to saying, hey, if you were a founder who grew up thinking all you had to do was code, and if you coded something great, you would be successful. We're now in a world where, one, that's commoditizing, and two, you're touching really important parts of companies. You better learn how to build relationships.
Sam, those kind of soft skills you're talking about, right? So build trust, the ability to read a room, right? Really, it's basically emotional intelligence. I mean, is there a class for that, Sam? Can you really teach that?
Yeah, I think you can. Look, the answer is, of course, you can't teach. You're not going to take someone who's never thought about these things and in a day leave them in a place where they're masters of it. But I'd say, one, there are basic principles or things you can come back to as kind of things to remember or things to keep in mind or frameworks. I think people really can up-level their game pretty significantly with just by keeping in mind. And then two, there are just tips and rules of the road that are quite helpful at first blush. So I don't think what our class is doing is claiming to be, it's not a PhD in etiquette, but let's just say maybe it's the intro class and help set people on the right course to thinking about what it really means to build trust in kind of this new reality we live in for startup founders.
It's funny, Sam, because I was born and raised in the Bay Area. I worked there for years as a tech correspondent. And when I was there, it was sort of like, okay, the tech community, it was hoodies and very smart people, very talented people, often very successful people. And yes, often kind of socially awkward people. But that was sort of, It was okay. It was almost, it was almost sort of celebrated. It was celebrated. Do you think that culture has changed, Sam?
I do. And I think this is actually, you hit on the key point, which is that if you think about it, the actual, the language of Silicon Valley for a lot of years, especially for the last, call it 15, has been, my technology is so brilliant, my product is so amazing that I demonstrate how amazing it is by having no etiquette, right? There's actually, when you wear a hoodie at a black tie event, the subtle social signaling to that is, I'm so good, right? And my stuff is so great that I'm intentionally breaking all of your rules, but you still should talk to me, right? And that worked really well in an era when software wasn't commoditizing, right? You really could, there were the luminaries did this, and then I would argue that went way too far down market effectively. But there really was this whole idea that anti-etiquette was a form of showing off how good you were, right? Or etiquette. And I think that is just really reversed in an era where all of a sudden, you have commoditized tech. People are scared in America of AI, right? Being the crazy founder who walks in and has no etiquette and no respect in a world where people are really worried about what AI is doing to the world, that's not how you build the trust you need to get access to mission critical data, to have conversations with companies about their workforce and what can be automated. This is not the world we used to live in.
But I take your point. AI has a PR problem. I am curious, Sam, you're a Facebook veteran. Do you look at Zuckerberg, Sam, and say, versus 5 years ago or 10 years ago, has his etiquette improved, Sam? What do you think?
I'd say yes, right? I think Mark, it's hard to argue that he wasn't kind of the tip of the spear of the etiquette, the culture of what we're doing is so great that I'll wear flip-flops all day long. I think that was absolutely an era, but the guy looks great in a suit in Washington these days. And I think that, when you show up, that is a version of what's happening at some level, is what I would say.
Yeah, maybe it's all that Brazilian jiu-jitsu we started doing. I think that could be key, Sam. Stick with Facebook. There was a story in the Journal. I'm interested to get your take on this. I don't know if you saw this. How Meta keeps delaying the release of its new AI model to developers. I'm just curious. Let's say you're a Meta investor, you're a viewer, you see that headline. Are you concerned at all, Sam, about whether these guys can they stick the landing? Do you have concerns about execution when you see a report like that?
Look, here's what I basically say. I say first, a line that a lot of people repeat, but it's true, which is don't bet against Mark Zuckerberg. I've tried it a few times in my life. It doesn't work, right? And so I'm pretty long from that perspective. I think he's a great leader, and the company's doing great stuff. I mean, as far as AI goes, look, from day one with LLMs, the most obvious application in the world of AI was simply that it could supercharge things like ad targeting and content, right? Like every other company had liability around AI. Meta was in this place where this is all upside. And I think that you're seeing a lot of that in earnings and what's happening, at the company. Now, what do you do beyond that? Mark's a very ambitious guy. They're putting a lot into infrastructure around AI. They just launched, I believe, a bunch of announcements around business enablement, et cetera. So that's all exciting. They're going to release the right stuff when it's ready. They did have a misstep with some of their AI models earlier, which kind of caused a full rebuild on the AI teams, et cetera. But now I think they're going to wait till they get it right. So look, obviously it being right and sooner is always better. But I think a lot of people are willing to wait.
Sticking with AI, Sam, OpenAI and Anthropic, I'm interested to get your take on this. Obviously, bitter rivals, fierce competitors. If somebody asked you, Sam, okay, explain to me the difference between these two, what would you tell them, Sam? Would you say product, distribution? Would you say corporate philosophy? And in your opinion, which has the stronger moat here, Sam?
Well, look, I mean, here's the I'm not sure about the moat question. I'm actually not sure any of these guys have a moat long term. But I'd say on a short term basis, if you really force me to describe the difference, what I would say is that OpenAI has been very, very broad, and Anthropic has been very, very focused, right, in terms of the products they've released. So OpenAI went through a period kind of waving the banner of AGI early on, which they absolutely did, and had some great breakthroughs there, of saying we're going to get all the talent from everywhere at any price, and we're going to do everything. We're going to make devices, we're going to do health, we're going to do consumer, we're going to do enterprise. We're just going to index everything. And the problem is that that's a very hard thing to pull off as you're growing, is to have that broad. It's biting off a lot. Anthropic has done the opposite, right? They really it's really Claude Code, which has been their big home run. They've been incredibly focused. And so I think what you're seeing right now is, that Anthropic bet right and released the right product that has really unlocked an enormous amount, specifically around coding and then specifically around, Claude Code, et cetera. And they seem to be crushing it, right? Which is why their revenue is now higher than OpenAI's. And what I do believe you're seeing a little bit is OpenAI trying to prune and get more focused again, because that really is the general everything versus the focused win.
Does it matter, Sam, OpenAI and Anthropic, who is first to market with an IPO? As an investor, I mean, does that matter or no? You know what ultimately matters? Who's got the best product?
Who knows? I mean, look, this is like Uber Lyft, except for you have XAI ahead of it. And before that, Google just sniped a bunch of liquidity out of the market anyway. So basically, everyone is just saying, let's go for mega fundraisers, right? And there are only so many consumer dollars floating around. So, look, I think it's kind of crazy how consumer or retail has been locked out of some of these, huge stories. They've obviously had the ability to get into NVIDIA and a bunch of other things. You've seen things like storage stocks ripping. So everyone's trying to figure out how to play AI, and there's obviously a lot of consumer demand. But I think the bigger story here is how much money really is there to go into these things, and where does it come from? Then secondarily, you play the question of who's Uber and who's Lyft.
Final question, Sam. SpaceX IPO. I'm interested to get your take on this. I was talking to a well-respected venture investor. And I asked him, hey, what do you think the public market reception of SpaceX is going to be? And he said, the mythology of Musk is a real thing, man. It's a real thing, okay? But on the other hand, he said, I'm not sure. It's a complex business. It's really 3 different businesses, 3 different growth profiles, 3 different P&Ls. It's a lot to understand. I'm not sure. What do you think?
I think that we're at a cultural moment. There is no way from a DCF basis or any sort of traditionally accepted accounting that SpaceX is a $1.75 trillion company in the framework of that we've all been taught and grown up with throughout the 90s and the 2000s. What I will say, though, is, look, people do store money and want to invest in stories. And if the story is compounding or growing, there's been a lot of history of that. Bitcoin is a story, gold is a story, Tesla is a story, Palantir is a story. And so it's a hell of a good story, right? This is the SpaceX one. And so I have absolutely no idea what's going to happen, but I honestly believe we'll look back at this summer and these IPOs as an incredible litmus test about what our economy really is and what we value and what we invest in and how we store and move money around, because we are in completely uncharted territory.
Sam, so great to have you on the show today. Thanks for your time.
Always happy to be here.
Coming up, 20-something YouTubers are making movies and killing it at the box office. We'll discuss why. That's next on Asking for a Trend. Well, it's a red-hot month for the box office, and May is setting the stage for a sizzling summer season, even an overall winning year. Here to discuss is box office guru editor Gitesh Pandya. Gitesh, always great to see you. So let's start big picture. This summer box office, how strong is it going to be, Gitesh? What do you, versus last year, what do you think?
Well, last year was an okay summer, not bad, but this year, the whole calendar year is stronger. So far from January until May, we are up 11% versus 2025. That's a great way to start the year. And the month of May was $1 billion. That's the first time we've done $1 billion since before the pandemic. So this is the great way to start the summer movie season because people are going to see all the trailers, all the posters and standees for what's coming up in the rest of the summer. And for the entire summer period, I'm projecting about $4.2 billion, which is really where we should be, the way we were before the pandemic.
What are the titles that are going to drive that?
Well, certainly right now we have a few movies out right now, but coming up later, Toy Story 5 is a big one. That's from Disney and Pixar that comes out Father's Day weekend in a couple weeks. That's going to be very big. The pre-sales are strong, probably over 150 million opening weekend, a massive movie, massive brand for Pixar. That's their crown jewel. Then you've got another kids movie, The Minions and Monsters. That's from Universal, Illumination. Those movies pretty much are bankable for $1 billion each. This is more of the same. I got to see some of the film in April at CinemaCon. The studio showed some of the footage of it. It looks like it's going to work with a target audience. And then you got Christopher Nolan. He's back with The Odyssey. That's more of a, for an adult, a more mature audience. That's coming in the middle of July. That looks like a massive movie. Matt Damon, Tom Holland, Zendaya. Speaking of Tom Holland and Zendaya, they have a movie 2 weeks later with the new Spider-Man film, Brand New Day. So two massive films opening 2 weeks apart. Hopefully there's space in the room, in the marketplace for both. But with Spider-Man as one of the biggest Marvel brands, that's another way to sort of end off the summer on a high note.
I want to go to the movies right now, Gitesh. On average, what am I going to be spending?
Oh, well, it depends on if you like those popcorn buckets, if you're addicted to that, because that is very popular right now. In fact, the Odyssey just came out with their new popcorn bucket. It's an IMAX camera, which has the popcorn in there. There's some that are sort of being wrecked upon on social media because they're not so good. But, the popcorn, the soda, that could run you about $20 right there. The movie tickets here in New York City, it's $20 for a standard movie. IMAX, 3D, premium, it could be up to $30 per person. So what we're seeing is that people are going for the experience. The movie itself has to give you an experience. It can't be something that you can enjoy at home a few months from now. A lot of films come out on demand very quickly. So some of the low-budget horror films that are working right now, Backrooms, which is #1, Obsession, which has been a runaway hit. These are movies that people are experiencing, especially the younger, under 25 audience, under 30 audience. They are going for that experience, the FOMO, everyone's talking about it, they want to be part of it. And in a theater that's packed, that's sold out, that you can't get into, you've got people really enjoying themselves, and it's worth that $20.
I guess I asked you a cost, Gitesh, just because I'm wondering, let's say prices at the pump do stay elevated like this, what could that mean for summer box office?
Well, so far it hasn't meant much at all. It's really product driven. So even though in the month of May you have high gas prices all across the country, when it comes to going to the movies, you drive, you park, sometimes you're paying for parking, but not in the case here because the box office is bigger than it's been before, and it's driven by the movies. The Devil Wears Prada started off the month. Michael Jackson movie held over from late April. Both did gangbusters. The only real disappointment for the month of May was the new Star Wars movie. That's going to end up being the lowest grossing Star Wars movie of the last 30 years or so. But everything else has been working, and people are fine paying that money.
You mentioned this. I just want to pull on this a bit. This low-budget horror film from YouTubers winning at the box office, Backrooms. Okay, this was a $10 million movie.
Right.
Bloomberg says its debut, Gitesh, was roughly on par with the opening of the latest Star Wars film.
Yeah.
What do you make of it? What's the impact there for Hollywood economics?
Well, it's a big shocker because Star Wars is one of the biggest brands. Now, granted, Mandalorian and Grogu is not one of the highest priced Star Wars movies. It's one of the lower, cheaper, if you will, Star Wars movies. But for Backrooms costing $10 million, the opening is over $80 million. Mandalorian also a little over $80 million. They're almost identical, those two movies. So it's the fact that people are coming out to the movie because of a specific reason, and that is because Backrooms has a built-in audience also. You don't think about it because Star Wars does, but these YouTube videos that this guy has created, I mean, he's only 20 years old. He can't even buy a drink for himself or champagne for himself after the opening weekend box office.
Incredible.
And that built-in audience came out to see what he has next, and you can only imagine that he's got agents and big paychecks coming up for next few films.
Last question. This issue of Paramount buying WBD, plenty of directors and actors came out, and you saw this, Gitesh. There were concerns. What's it going to mean for Hollywood going forward?
Right.
What's it going to mean for theatrical releases? Do you share those concerns?
Well, I share some of those concerns. I think overall you want to have more supply. You don't want to have less supply. So the studios are saying they're going to keep their supply and their number of releases steady over the course of the years. How many years will that be? We don't know. Will they stick to that? We don't know. But overall, if there's less competition, a lot of people are afraid of, well, what are the rates going to be for actors, for directors? So these studios are going to have more control over what projects get made. Will it be only sequels all the time? Not as much original fare getting through the studio system. So those are all valid concerns. I think that a lot of groups who are protesting that have their opinions out there, and the legal process has to sort of play itself out. But if it goes through, then starting next year, we'll start to see whether they really stick at the level of 30 films a year.
Here's another person who was concerned. I don't know if you saw this. Quentin Tarantino.
Yeah.
Did you see? He slams Hollywood.
Yeah.
Flavorless sausage factory, he says. Just plain stupid, he argues. What do you make of that?
Well, he is never one to sort of hold his opinion back, right? And his movies, he kind of made this rule for himself that he's going to make one more film and then retire.
Yeah.
We've been waiting and waiting for that last film, so he's kind of stretching that period out. But he makes a point in the sense that people don't want to see constant sequels all the time. But what we're seeing at the box office recently is that a lot of original films this year are working. The Backrooms, The Obsession, working very well. And then you have Project Hail Mary, based on a book, but basically it's an original film. It's not a known quantity at the box office. Did gangbusters, over 600 million around the world, a huge hit. And you have more coming up this summer, so we will see some mix of the original, the IP that works, along with these newer films that are kind of testing the waters. And more importantly, with these younger directors that are coming out right now, they're bringing younger audiences in. The under 25 audience is coming out. The attendance is at a rate higher than we've seen in a long time. And that's good for the long-term health of the business.
What's playing right now? Like you would say, Gitesh, Josh, if you're going to go to the movies, you got to see this. What is it?
Well, let's see. This weekend, there's 2 new movies opening. I wouldn't say you have to see them. Masters of the Universe.
They're not must-see.
They're not must-see. I like Masters of the Universe. I was a He-Man fan growing up, so that was an enjoyable film. Not like the best of the year. Scary Movie is another one that's getting some of the worst reviews of the year, but again, that's not made for critics. I would say Obsession is one of the better films that's playing right now. I liked it more than Backrooms. And then going back to the rest of the year, Project Hail Mary was very good. That was a solid film. Michael was an okay movie, but if you like the songs, then you enjoy that. And then the fans are loving it. Over 850 million at the box office worldwide, probably going to make it to $1 billion, the biggest music biopic in history.
Wow. Gitesh, always great to see you. Thank you, sir.
Great seeing you. Thanks.
Stick around. Much worse for a trend. That's still to come. That was perfect, man.
Cool, man.
Perfect. I love it.
Good talk. Feels like
Time now for To Watch Friday, June 5th. Taking a look at the labor market, all eyes on May's jobs report. Investors will be watching for any signs that the labor market continues to cool or heat up despite higher interest rates. Economists forecast the U.S. economy to add 85,000 jobs, signaling a slight cooling in the job market. The unemployment rate is expected to hold steady at 4.3%. Investors watching for any move higher that could signal softening in labor conditions, giving us more insight into the overall health of the hiring landscape. And finally, economists expecting average hourly wages to tick up slightly to 0.3% on a month-over-month basis. Wages providing a key piece of data engaging whether inflation pressures in the labor market continue to ease or remain sticky. The latest jobs report giving the Fed a critical piece of economic data as it charts the path forward for interest rates. That's a wrap on today's show. Thanks for watching.